It has been an extraordinary last fortnight, with US trade policy deployments causing highly significant changes to investment markets throughout the world and noteworthy volatility across all asset classes, as market participants attempted to digest the economic impact and reprice asset values against a backdrop which, quite frankly, has been so fast changing that it's been difficult to keep pace with. We have a range of portfolio managers scheduled to record upcoming episodes for the Investor Insights series, and we will be asking many of these how they're currently navigating this environment. However, over the spring and summer months, we also will be featuring a range of less correlated investment strategies, which we believe can provide very useful ballast and diversification benefits to broader traditional portfolios, particularly as volatility could well remain heightened for some time to come as the full impact of these profound changes to the world order feed through to the economy. A good example of such a strategy are those run by Ennismore Asset Management, and last week we were delighted to be joined by Richard Stuckey. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killik.com. In this episode, we were joined by Richard Stuckey, who joined Ennismore in 2017, having previously worked as a generalist analyst on European equity funds at Adelphi Capital. Richard runs a portion of capital for the Ennismore Global Equity Fund. The Ennismore asset management business has some really quite unique features. It has very deliberately limited capacity of assets under management. It structures the investment team to be fully aligned with the long-term success of the strategies, and ensures the team are allowed to focus solely on independent research. All these features we touch on directly in our discussion, and which I think will also come across loud and clear throughout the conversation. Ennismore has two investment mandates: the European Smaller Companies Fund, which launched on the founding of the company in 1998, and the Global Fund, which launched in 2016 and is run using the same philosophy, but as the name suggests, with a global remit and a focus on slightly more liquid equities within the investment universe. These are both long-short equity funds, meaning that strategies will comprise both long positions in equity securities of companies where the portfolio managers see good prospects for capital appreciation, alongside positions which are sold short in companies when the team forecasts share price declines. And we discuss the investment process behind both these parts of the portfolio in our conversation. I am responsible for managing a discretionary investment strategy for Killik Co clients focused on alternatives, which we define as assets and investment strategies which sit outside of traditional equity investments and fixed income securities. The exposures within this strategy are diverse and include assets such as commercial property and infrastructure, and a number of the portfolio managers we have already spoken to during the Investor Insights series feature in these portfolios. However, another component part of this investment strategy allocates to a varied range of hedge funds and strategies exhibiting low correlation to the core spine of most people's investment portfolios, being equities and credit or fixed income. Ennismore is a good example here. If we take the Ennismore Global Equity Fund as an example, the strategy does tend to have a net long bias, meaning the long positions tend to outweigh the short positions in terms of size. However, the correlation coefficient of returns and the beta, both statistical measures which give an indication of the relationship between different asset classes or investments, have both been near zero over the last 5 years when compared to the broader global equity market. It is these sorts of strategies, with the ability to generate returns irrespective of the overall direction of broader markets, which can provide very useful diversification benefits to broader portfolios. As always, we hope you enjoy this conversation, and please get in contact if you have any questions or would like any further information. Richard, good morning. Thank you so much for sparing some time for this, particularly on an extremely busy week in the markets. How are you doing today?
I'm doing well. Thanks for having me, Gordon. Yeah, it has been a tough week. I'm actually away, going from the rest of the day for a couple of days for a break, so it'll be a welcome relief.
Yeah, well,
I'll try and stay off Twitter.
yeah, absolutely. So, Richard, we got this kind of standard first question to these that we ask everybody, and all it does is try to get a bit of an insight into kind of how you go about your work and how you go about things, really. And we ask if there's an anecdote from a recent trip or meeting that you've been on, or a research project that you're kind of working on at the minute, or even just an article or book that you've read. Anything that you could share just to give us a bit of a look into how you go about things.
Yeah, sure. Well, I guess we like to revisit companies when we're researching them. So I did visit a pig processing factory that's owned by Cranswick last year, which was a proper experience. I'm not sure I have massive insights from it. Maybe more insightful though was a series of meetings we did in relation to a company we do own, which is Baltic Classifieds Group. So we visited the company. They're based in Vilnius. So it's a classifieds business, a bit like a Rightmove or an Auto Trader, which operates in Estonia, Lithuania, Latvia. As I say, they're based in Vilnius. So we flew out to visit them. We met the CEO and 4 or 5 of the senior team. But then we also wanted to get perspective on the management team, because this is it's very people-based business, I guess, and we wanted to get a perspective on the management. He's run the business for 20 years. And so we met with 2 of the board members. So we met with the chairman and another senior non-exec. And I guess I've never had such overwhelmingly favorable feedback on a CEO. It was remarkably positive from 2 signs of the industry, both on all sorts of his characteristics. So being great leadership, clarity of thinking, his passion for the business, his thoughts on capital allocation, but also his humility. And then finally his bravery. So there was a story where he shut down an existing business and launched a totally different model during the depths of the financial crisis in 2009, and managed to, the only case I've seen of a business toppling a leader in the classified space, which is driven by network effects. And so that was very interesting. And then these guys, they were ex-CEOs and chairmen of Auto Trader and Rightmove, as well as some other classifieds businesses. So they gave us great insights on the rest of adjacent insights on the rest of the industry too. So that was the one I'd highlight.
Yeah, no, very interesting. Yeah, thanks for that. Yeah, that's kind of given us a little bit of an insight into the kind of process, I guess, as well. But I did wonder whether we, just to kind of frame the rest of the discussion, whether I could ask you just to kind of talk through the main features as you see it that kind of differentiate Ennismore as an asset manager, because there are some quite differentiated features of kind of how you go about making decisions, kind of across the team, how you create that portfolio. Could I ask you just to kind of summarize some of those just for the audience?
Yeah, sure. So it's an unusual business. So it was set up by Jeff Oldfield over 25 years ago now. And one of his principles is that investing is best done by an individual. And yet we have a team of several people. And so the way we balance that is we have 4 or 5 portfolio managers on the team, and each of them essentially manages their own portfolio. So obviously we do talk to each other. It's not like we're sat in silos ignoring each other, but we manage our own portfolios, and then our compensation is tied to our own portfolios as well. So that's one of the things, I suppose. But hand in hand, when people think of multi-manager funds, they often think of Citadel or Millennium, and very, very tight risk constraints and quite short-term thinking. We're the opposite of all those things. So we think long-term, we don't have such tight risk constraints, and we have more flexible mandates. So within the global fund, we don't allocate people sectors. Everyone has a free rein, both by country and by industry. I suppose a broader theme on the business is, we prioritize performance over asset gathering. So, we've deliberately kept the fund small. The European fund that was the original fund of the business was closed for many, many years, not taking in any assets. And then we have a clawback incentive scheme. So we do get bonuses on our performance, but most of it is held back and invested in the fund and then only paid out 3 years later if you haven't lost the money in the interim. And then I suppose the biggest thing I would say actually is the people and the kind of cultural characteristics. And so often when you meet people from a business, you have a decent idea of what they might be like. So not to pick on them too much, but if you think of Goldman people, I don't know if you've met many, they tend to be super slick. So they might not be whatever the content of they're saying, it's going to sound very persuasive. They're extremely good presenters and talkers. I'd say if you ask me about Ennismore, I'd say we're candid, authentic, maybe even a bit guileless. And that kind of goes hand in hand with what I think of as an investing characteristic, which is independent thinking and a tolerance for being different or willingness to be contrarian. Doesn't necessarily help us with marketing very, very much, but I do think it helps us with the investing. So those would be the feats I'd call out.
Yeah, no, absolutely. I think that summarizes it well in terms of they're really quite a unique asset manager, I think, compared to a lot of the kind of peer group, I guess. So yeah, thank you for that. Then
maybe just a Goldman person to help us with the marketing there.
Yes. Richard, I wonder, obviously, long short strategy. I wonder if we could just say kind of add a bit of structure to the conversation where we could go through the kind of the process on the longs, and then we'll kind of touch on the kind of short book and how you're coming up with short ideas. Surely, but could I ask what are the kind of general characteristics that kind of typify a long idea for the Ennismore portfolio?
Sure. I mean, given what I just said about the multi-manager portfolio, the names have less obvious characteristic profile than maybe with some funds, because different PMs will have different styles. But all of us are, trading off what we're doing. We're trading off quality, growth, and what we have to pay. That's kind of how I think about when we're making a long investment. Was quality? It's maybe the best single metric is return on capital, but it goes to as well robustness of the business to change or to competition, its market position, its power over suppliers or customers, which is probably summarized best in its pricing power, the durability of the business and its competitive advantages. So those are all the things we're looking for when we think about quality. And everyone within Ennismore will have a kind of minimum threshold for that. We're all very focused on valuation too. But the big unifying theme is margin of safety. So we want to, we know we're going to be wrong when we're doing analysis a lot of the time. We'd rather not cost ourselves too much when we are. And so the way we achieve that is by trying to have a margin of safety in the price we pay relative to what we think we're buying. And then that margin of safety that you need depends, going back to this trade-off that we're making, a higher quality business, the range of outcomes is more narrow than it is for a lower quality business. And so the margin of safety that you need in terms of valuation then is less. In terms of bringing that into reality a little bit, for me, the way I probably bias more to slightly higher quality businesses than some of the other PMs within the firm. And the way I navigate the universe is by thinking about durable, very what I'd call convergent business models that kind of endure over time and that you find across different industries and different countries, that or at least give me the best confidence, I suppose, that those high returns on capital I'm looking for are going to sustain. And so examples would be, businesses with network effects, such as the online classifieds businesses I already talked about when we were talking about Baltic classifieds. And those are very self-sustaining because the customers want to be where the vendors are, and the vendors want to be where the customers are. And then you get all kinds of data integrations that sustain that position, or what I'd call a friendly middleman business. And this is where, so a good example within the portfolio is a company called Dietron, which owns Belron. And Belron is the world's biggest provider of windscreen repair replacement. So it owns Autoglass in the UK. And they have the same jingle worldwide, that annoying jingle that you hear kind of every few days on the radio. And the way that business works that relates to this model is, most of the claims, most of the windscreen replacements that happen via your insurance policy, your car insurance policy. So you don't really know what the price you're paying is. You're not actually the person who selects the provider. You do it through your insurance, and then the insurance, covers it for you. And so effectively your insurance then is your customer, but also your salesperson. And so that dynamic where price the end customer isn't the person paying, and where the pricing is non-transparent, can lead to very defensible and very sustainable returns.
Yeah, yeah, no, absolutely. Which you mentioned that kind of those businesses with the kind of network effects and online classifiers. You've been mentioning two questions. Could I ask you to maybe just delve a little bit deeper into kind of the attractions of those and kind of where you're finding those types of businesses, and kind of the investment case for kind of having them.
Yeah, of course. So you see them in lots of places, and this is a particularly a feature of the digital world, so post-internet world, that we see many more of these network effect businesses, but they go back a long time. So perhaps two of the best examples that everyone will know are the card networks.
Yeah.
So MasterCard, Visa, and American Express, say, and then so it often happens in software. So Microsoft, it's pretty annoying. One of the reasons that Microsoft's been so self-sustaining is that if you send a Word doc or an Excel doc, you need to be able to open it, and so everyone ends up on a standard. The dynamic, though, in terms of what it means is that the product is worth more, is more valuable when more people are using it. And the way that dynamic works in terms of the businesses that we own is with the online classifieds. If you're selling a house, you want to list your house on the platform where most people are going to buy it. And if you're buying a house, you want to look on the website or the app where all the properties are. And so that's a very strong centripetal force that keeps people, both sides of that network, on the same platform. And it's very, very difficult to break that. What it means as well is that those businesses, because they're all digital businesses, you have enormous amounts of information about what your customers are doing, what they're looking for. So if you're looking for a house, Rightmove will probably know before almost anyone, maybe before your friends do, that you might be thinking about moving. So if you're living in London and think about moving to the countryside, Rightmove will know that because they'll see where you're searching. And so they can then send you ads from local estate agents in the place that you're moving to, and no one else would know that you're going to do that. So they have all this very valuable information that allows them to monetize their customers very well. And then from a financial characteristic standpoint, what these businesses have is extremely low capital intensity because there essentially is no capital to run them. They have very high margins, very defensible competitive positions, and they're growing typically, high single digits or sometimes low double digits, but without any capital. And so all of the earnings that they're generating, they can distribute to shareholders or use to create value for shareholders. And then they're growing at the same time. And that's a really incredibly valuable combination. Obviously, you need to be cognizant of valuation. And the most attractive one for me at the moment is Auto Trader within that space. It's trading at, around 20 times earnings. And I think it's going through a phase where its revenue growth is going to accelerate because they're bringing a kind of online digital buying process. They're inserting themselves more into that buying process. You can now reserve a car on Auto Trader, and rather than having to go and negotiate with the dealer in person, and that obviously makes them more obviously valuable to the dealer, and they're able to charge more as a result. So I think we're going to see a revenue acceleration. Meanwhile, it's trading at a historically low valuation.
Let's maybe move on to the kind of short positions, and we often hear you kind of describe kind of three different camps that I guess short positions could fit in. But I wonder whether you could kind of talk us through the kind of the deception thesis, like you call it, or where there's structural failure and the over earners. Could I ask you to kind of talk through kind of how you're uncovering some of these short ideas?
Yeah, of course. Probably our favorite one is deception, as you mentioned, and so this goes across a range of things. So that there's both kind of outright fraud, which is you see surprisingly often in capital markets, but it's it's not that common. Probably one of the most famous examples recently being Wirecard, but there's been plenty over the years. But it also includes aggressive accounting. Accounting allows companies some discretion, and so in the areas where there's more discretion, companies will use it, particularly the management teams with less moral fiber. Sometimes it starts from a position of just trying to make their most recent quarter. They're going to miss numbers. They maybe tweak a few decisions just to push it to be able to hit the numbers, and then that escalates over time. But you do see some pretty egregious accounting sometimes. So that would be an example of deception too, where companies effectively the numbers they're reporting don't represent the reality. And so on the numbers side, we'd be doing that mainly via screens and then investigating. On the more fraudulent side, that comes about mainly, the way we track it is by people. And so sometimes you see managers who have repeat offenders in this in this space, and they, for some reason, keep being given opportunities to run businesses and being given capital by investors, particularly in the US. But you also see it through advisors. So if you're bringing an IPO to the market and it's a dodgy company, lots of advisors out there won't support you and bring it to market, but there are those that will, and so the advisors can be a good screen for if you're an advisor with a low threshold for your business, then people are going to find you, and so those guys are a good source. So and then there's all sorts of random ways we find things too. Perhaps one of our best recent examples, going back a few years, was an Italian business where myself and a colleague both found it the same day. One was I found it through my network. Someone mentioned it to me as a potentially interesting idea, and my colleague was running this statistical screen where on the distribution of numbers in the financial accounts. And there's a guy called Benford who's a statistician. He said a random series of numbers should follow a particular distribution where you see more ones, more ones and twos, and there's a kind of decreasing proportion of numbers as you go higher up. And so you can run financial accounts against that statistical model, and if things are very off, maybe that's a sign that the accounts might be made up as well.
Right, yeah, fascinating insight into how the process works. Yeah, thank you for that.
And then on the structural side, I suppose that's often being an awareness of trends, really. So example recently would be something like the enormous increase in exports of cars from China. So China taking a much bigger share of global car volume. And then car component suppliers is pretty well known to be a tough business. Car procurement is very demanding. Their demand price decreases year on year, and so those businesses are pretty hard. You're also facing a large customer, but not only is this then a tough business, but it's a tough business where you're selling into European or US producers who are seeing a declining share of the global market. And so an awareness of that trend, allied to observing the accounts and seeing the pressures in the businesses building the accounts, can then be a nice combination.
Yeah, thank you for that. Richard, we had a recent meeting, and one of the topics we discussed was some kind of elements of the risk management process at Ennismore. One of the things you mentioned was talking about this kind of emergence of more speculative investment within the market. You kind of saw this through the COVID period, I guess that kind of meme stock type phase that we had, and kind of how you're trying to tackle those sorts of things within the market with kind of how you monitor things. Could I ask you to kind of talk through risk management and how you look at things in terms of the portfolio?
Yeah, sure. I mean, I suppose going back to the previous conversation we just had around that deception theme, when you're trafficking in that kind of short position, you're naturally going to find yourself in the types of stocks that you're talking about. And I guess the reason for that is, if you're a fraudster in the stock market, you need to be good at selling a story, and you're going to find areas where there's a story to tell, right? You're not going to go and look into kind of selling wheels for tractors or something like that. You're going to be going into AI or crypto or going back a few years, cannabis or whatever. It needs to be a theme that's exciting to people, where there's a narrative to tell. So that gives you an idea of the areas you're going to be looking for. But if someone's a very good storyteller and they're in an area of the market where there's a lot of excitement, obviously that can be a bit dangerous. And so people can dream about these stocks, and that's one of the reasons why they become very overvalued. So it's almost inherent to, as I say, trafficking in that kind of short, that you will face this risk. And what that means is you need to be able to manage that risk. And sometimes we get it wrong, but over time it adds value. So we did an analysis earlier last year where we looked back over 3 years, and that deception theme, particularly the more aggressive end of it, had generated a lot of value for us, even including a few mistakes on this monitoring process for the meme risk. And then how we're doing that, particularly since we hired a risk manager. So we hired a risk manager for the first time in the summer of 2024. It's someone that I knew from back when I was at Adelphi, which is where I worked before joining Ennismore. So he's very capable on the quant side, and effectively he's brought a more rigorous quantitative risk management approach to these stocks, which involves a whole load of data stuff that's too complicated for me to understand, but scraping of social media, analysis of volume trends, analysis of option trading dynamics, and and unusual patterns of option trading. So he puts all those things together into a kind of Z-score framework, and we'll point out names that are particularly susceptible. Because the thing with this stuff is it's pretty easy to say, you know, something like GameStop or whatever is a meme risk short, but you need to draw the line. You need to choose where to draw the line so it's useful, without excluding all of the potential names that could generate a lot of value on the short side.
Yeah, sure. Yeah. Which I wonder, the other question I was gonna ask on just kind of how you're kind of thinking about things in terms of the general investment environment. I think it's become very clear it's very much kind of a stock specific focus with what you're doing, but I'll be interested to hear kind of how you're viewing kind of recent broader market trends, things like that increasing in index concentration or small caps kind of underperforming, that the kind of mega caps being the kind of dominant driver of markets, and also the kind of passive investment kind of gaining ever more share, just all things that are kind of really impacting trends within markets. How is that impacting the opportunity set for a manager such as you, kind of long short managers?
Yeah, it's a really interesting question, Gordon. We actually wrote about this in one of our recent newsletters, and I would refer your listeners to a paper that Cliff Asness wrote as well, I think back in August, September last year, where he discussed some of these themes, and I thought in probably one of the most compelling ways that I've read. But I suppose one other theme I'd draw out, in addition to the ones you mentioned, is the geographic concentration. So we've seen this large cap concentration across different markets, and to some extent that's justified given, you know, increasing returns to scale. This dynamic we talked about with network effect businesses, you know, Facebook and Google and Microsoft, these are uniquely powerful business models. And so it's not that we can dismiss this as entirely driven by speculation and valuation anomalies, but it is also unprecedented. And then the US concentration of the market is also pretty unprecedented. So I think before this recent sell-off, the US was probably 70% of global market cap, when it's 25% of global GDP, and that's a pretty big divergence, and who knows if that will sustain, but you know, history would tell us it probably won't. I suppose in terms of how it's influencing us, well, on that geographic theme, we're finding more opportunities in Europe and the UK in particular, as well as Japan, than we are in the US on the long side. I suppose that's one thing, but the theme I mentioned around what Cliff Asness said, you know, he's basically saying, look, the two big themes are indexation and then social media and kind of maybe Reddit driven investing, going back to this meme stock thing. And that's, you know, people, very obviously people investing for reasons that are totally unrelated to price. And so I suppose the more of the investment world, more investment decisions that are made for reasons that are not related to price, the more opportunity there should be for mispricings. And I think, you know, we do see that. The difficulty is, are you able to take advantage of them? And obviously risk management comes into that, a long-term mindset comes into that, and then turning over a lot of rocks comes into it. And I guess I'd agree with his conclusion as well, which is, you know, we see more opportunity, but it's probably going to be a bumpier ride. And so, you know, then it goes to, you need patient investors. You need investors who are going to support you, believe in what you're doing, and be willing to tolerate potentially some more bumps in the road than there might have been in the past, because of, you know, when there's more investors who are investing in unrelated to price, maybe prices move further away from fair value before the weighing machine takes effect.
Yeah, no, thank you for that. We'll maybe put a link to that research paper in the comments if we can. I think I read it. I think probably on you mentioning it, but it is a very good. It's trying to explain that kind of value spread, isn't it? The kind of that rise in the dispersion between the highly valued and the lowly valued stocks in the market. So there's
Exactly, yes. Yeah, and we discussed it, I think it was our September.
Oh, okay, that's probably where I got it. Yeah, thank you for that. Richard, our last question is a kind of another standard question, and it asks the speaker just to highlight kind of one area that they have a particularly high conviction in at the moment. You've mentioned a few areas already, but if there was kind of one area that you'd highlight at the moment,
Yeah, well, in some ways it's quite an exciting time for me, because I suppose what I think of as my core areas have been, I mean, it's been painful, but have been selling off over recent times. So, you know, some of these business models that I really know well, that are my favorite place to hunt for ideas have been relatively weak. And I guess that one of the reasons for that, I think in Europe, for instance, with all the excitement around the German fiscal stimulus, and also with the need and desire for Europe to rearm as the US security umbrella goes away, there's been a much more intense focus on asset-intensive businesses, defense businesses, and with how the capital markets work, capital gets drawn away from areas to invest in the new shiny thing. And so, some of those, particularly the defense businesses, they're trading at reasonably punchy multiples. Now, they may grow into those, but what it's meant, I think, is there's a distraction away from some of these great, steadily compounding businesses that I like and I think are very durable. And so, if I look at across some of the names that I'm a big fan of, Auto Trader is probably down 20% or more since the recent peak in October, November. And I think its prospects, maybe short term, they're slightly different, but I don't think its prospects are any different than they were back in October. And so that's become much more attractive. Another business, Paradox Interactive, which is makes these slightly geeky strategy games. Again, that's down by 25% versus a few months ago. You can track the trends in players online. They're still growing 10-15%. There's no dent in their kind of operating performance. It's just available at a much more attractive valuation. Wise, which is the world's biggest money transfer business, again, that's down 20-25% over 3 months. Despite just having had a very positive capital markets day and with no kind of obvious dent to its operating performance. So I suppose that would be what I would say is some of these asset-light, long-term compounded businesses that I think are very durable, but are kind of maybe not quite in favor.
Yeah, just being impacted by other market events at the moment. Yeah,
and I guess they have the advantage of being insulated from what's going on with the trade war.
Yeah,
the trade war is obviously focused on goods for one. And a lot of these businesses, some of these businesses are domestic, and so whilst there may be secondary implications of if there is an economic downturn, they might be impacted, but they're almost entirely insulated from any direct impacts of that.
Yeah, for sure. Yeah, no, thank you for those examples, Richard. Always really interesting to chat to you. Thank you so much for sparing some time this week.
No, thanks very much for having me.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.